Welcome to the daily stock review of Innovative Aerosystems. Goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey, just 2,500 hours in over the last 7 years. I'm sharing the lessons along the way. This is my investing process. Today I'll go over how I came across this company and the 5-minute check to see if it's worth looking into further. These are the guys I learn off. They did pretty well for themselves over just a little while. Following the breadcrumbs they've left behind, should be able to follow in their footsteps. If you'd like the free investing resources that I wish I had when I first started, you can check those out with the link in the description. They're free. It's my gift to you guys. Let's get started. Alright, so Innovative Aerosystems is previously known as Innovative Solutions and Support Inc., with a NASDAQ ISSC ticker. Now, it's been around for quite a while. Must have been a fair bit of hype and maybe a couple of big contracts maybe potentially back here, but the stock hasn't really done too much for quite a while until the last pretty much year or two, where the stock price has pretty much gone from a low of, say, the mid single digits, and then it's kind of risen right up. Now, it's kind of funny. You've got two kind of peaks going on here, or rates. You got the peak that does look like exponential growth, and then you've got these lows that keep coming back in, and we're kind of in the middle of one now where it's maybe starting to rise back up, but you can see it's sitting at $20 a share, and the price to earnings ratio is still only around 21, 22. So how did I come across this business? I was looking for small caps, so businesses that are smaller than $2 billion and ones that have really high revenue growth over the last 3 years. So this may potentially explain what's going on here. So let's have a look at this 5-minute check. So I've jumped in already, gone to annual reports, cracked open the latest one, and what I'm looking for is the financial statements. What I want to look for is kind of three things. I want to see mastery. So has the business mastered its customer? Should be able to see that in revenue, strong revenues, and hopefully growing. And then we also want to see it in terms of a moat around the business. We want to see good margins. And then third, I want to see management. So management spending the company's money wisely. So let's have a look. We've got revenue here. It's gone from 22. What are we talking in? Doesn't say it's in thousands or millions, so it's literally just going to be 22.5 million, 24 million, and then boom, 54 million. And that's from the product side of the business. Now, for the services side, we've got 12 million, 22 million, and then 30 million. Ooh. So we've got, just under a triple in services growth in 3 years. And then for product, it's just a teeny bit more than doubled. So total net sales has gone from 34 to 47 to 84 million. So that's pretty strong growth. And so this would have been the number that the screen was looking at. And having a look in here, you can definitely see that these are some interesting numbers, especially in the services part of the business. Now let's see how much of a margin they're getting from each part. So for product, it looks like 54 to 27. It's about half. So 50% gross on the product side. That works out about the same across these other years. And then the services division is about the same. So another 50% gross there. And that works out pretty much the same on the total cost of sales. So that is a pretty good margin, especially on their products. Some businesses, if their products are a bit more commoditized, they'll be quite expensive, but they might not have a high margin around it. They might be very razor thin there. But for here in this business, it does look like they're selling products and then they're providing the services to support that. So that is a great way to get a foot in the door. All right. So what have we got? Total operating expenses, research and development has stayed fairly steady. Selling, general and admin has gone up, but it hasn't grown at the same rate that the revenue has, which is good. So let's just have a look at net income. Net income's gone from 6 million to 7 million to 15 million. So it's doubled over that time. A little bit more, 2.5 times. So pretty good opportunity to look into. Let's check the balance sheet just to make sure there's no hand grenades that are gonna kill us when we least expect it. So total assets 103 million versus total liabilities of 38 million. So we always want to see total assets more than total liabilities. And the long-term debt, what's the trend here? Looks like it's decreasing from 28 million down to 21 million. Total current liabilities, is it just because? Nope. All right, so accrued expenses, accounts, current portion of long-term debt. It's 2.5 million due this year. All right, so that's pretty good. What else we got? Retained earnings. So we can see here that the business has been profitable for a while. It's not like they've got accumulated losses and things like that here. So that's a good sign. So far, I know that the business has mastered its customer. It's got really good, strong revenue growth. It wouldn't be selling more products and services like that if they had a shit product and terrible service. What else? And the margins that the business has got as well are pretty good. So they do have quite a few expenses and things like that coming back out of the business. One to watch out for. It's not a bad thing at this stage, is the selling, general and admin creeping up. All right. Let's have a look at the cash flow statement. So we've got our net incomes, they come out at the top. Then we have these adjustments that come out. Now, all I'm looking for here is anything that is weird and wacky and really big compared to previous years. So we usually expect the bottom number to come out of this to be pretty lumpy. Inventories is really high for this year compared to previous years. There are a couple of other ones like accounts payable, accrued expenses, contract liabilities, all bigger this year, but makes it a bit of a funny number when having a look at the net cash provided by operating activities. But let's just take it on face value. For simplicity, we've got 2 million, 6 million, and 13 million. Boom. So that is some really high growth in terms of the cash that the business has generated there. And let's have a look at where the business has spent that money. So purchases of property and equipment. We've got a big increase in the most recent year. So it's gone from 300,000. It's gone from 300,000 to almost 700 to 6.5 million. So over the year of 2025, they've invested a fair whack of money. And so that wouldn't be their kind of standardized property and equipment expense, but they've obviously had an internal growth opportunity to build or purchase some extra equipment, and they've executed on that. What else have they done? Acquisition of assets. So they've done that in a previous year as well. And then they've also got here acquisition of a business. So they've spent 35 million and 14 million previously to acquire some parts of businesses, and that's where they've fueled some growth from as well. So that's interesting. They've done some here, and then they've also done some internal growth as well. All right, so they're obviously spending more cash than the cash they're generating. So where's that cash come from? We've got debt proceeds. So they got 20 million, 52 million previously, and then debt payments, which effectively kind of cancels that one out. And then they've also paid an amount this year. They've got initial term loan debt proceeds. So bought some. And it's just been the debt. And the debt that we saw on the balance sheet wasn't too crazy. So it's not like this business is loaded up with a heap of debt just to fuel that growth. It's got a fair bit of assets, and it's probably a pretty smart decision to just creep up a little bit there. It doesn't appear that they've proceeds from exercise of stock options. So they had 408,000 in stock options previous year, but that would have been not capital raising. That would have just been actual payout to the management team and things like that. So they're not diluting the long-term shareholders by just asking for more money from investors. It does appear to be a pretty reasonable and smart decision to go and fix up with this debt. And if we're performing a deep dive, we'd need to go and have a look at what's their business's long-term strategy. And from these acquisitions, what kind of income is the business making? So if a business or the management team want to buy different businesses and assets, we want to see that those individual purchases were smart. And if we can work that out, that gives us an indication for how rational the management team are. If we come a couple of years later and that business unit that they purchased, that they've bolted onto the existing business, isn't producing any cash and it's a shit investment, all that means is they made a poor decision. And that's just one bit of data to take on board. Now, if they've done it again and this one ends up being good, or it ends up being a terrible investment, they aren't able to realize the benefits from it, then that can be a bad decision as well. What we want to see is that business and the management team are making great decisions year on year. And we can back that up with results, because that'll help us have an indication for if this business is going to continue to grow into the future, and if what they've acquired is a long-term thing, or if it's just short-term 3 to 5 year contracts that they're then going to need to redo in that kind of time period, and there's a risk there that they lose, for instance, maybe 50% of their revenue. So we need to do that deep dive and check it out. But otherwise, is this business interesting to have a look at? Yes. It's definitely worth having a look into. I'll be doing a deep dive on it and include my analysis in my other community, which is the link in the description if you guys are interested. Otherwise, for me and for you guys, the things that I'd be looking out for is exactly that. Having a look back at the previous decisions management's made. I'll probably crack open the previous annual reports, look through the description of those purchases, and also have a look at the trend of where this extra revenue is coming from. And if you like this, you probably like this next video, so check that out. Cheers.